Before we head on to the video today, I have a very special gift for you, and that's the REITs 2023 Handbook. You can find the link in the description below. Click on it and you can download the handbook for free. Go ahead and do it now and the video will wait for you. Hi there, this is Alvin from Dr. Wealth. Today, I'm going to talk about your favorite topic, which is REITs, R-E-I-T. So we know that there are REITs that have Singapore-based properties and there are also REITs that have overseas properties. Both can be listed on the SGX. And based on my observation is that the overseas REITs tend to be underperforming over the years, while the Singapore-based REITs tend to do better. So I wanted to really figure out whether this is true. And I started to dig out their 5 years performance that inclusive of both the capital gain as well as the dividend gains, because for REITs it's very important to consider the dividend as part of the total gains, since that they usually distribute majority of their earnings as dividends. So that is the total dividend that will be comparing among all these REITs in the past 5 years. And how do I differentiate whether it's a Singapore-based REIT or an overseas-based REIT? Because there can be some REITs that have both, right? Some in Singapore, some in overseas. So the cutoff for me is if the property portfolio has more than half of Singapore properties, then I'll consider it as a Singapore-based REIT. And if it has less than half that is Singapore properties, then I will consider them as overseas REITs. Okay, so now you get the definition. It's time for us to go into the results. So you can see in this image, this is the Singapore-based REITs that I have gathered, right? So the performance is comparing to past 5 years, right? So if REITs that do not have any 5 years performance shorter than that, then I will also exclude from this comparison. So I wanted to get the full 5 years. So you can see that the overall Singapore-based REITs have done quite well, right? They can be either in commercial, can be industrial, can be all sorts of, all types of REITs. But overall, they have done pretty well. The average return in the past 5 years has been about 27%. And if you take a look at the number of REITs that have positive returns in these past 5 years, majority of them have achieved it. So only 3 out of 15 local REITs have been making losses in the past 5 years. So which means that if you buy any Singapore-based REITs in the past 5 years, your chances of making money is on the higher side. And now let's look at the overseas REITs. So there are 19 overseas REITs listed over here, and you can see that majority of them actually lost money, such that the average return for these overseas REITs are negative 12% in the past 5 years. So likewise, if you have invested in any overseas REIT since 5 years ago, it is highly likely that you are seeing a losses despite collecting all the dividends through the years. So the results sort of like validated my observation that Singapore-based REITs tend to do better and the overseas REITs tend to be the underperformers. Of course, there are exceptions, right? Like Mapletree Logistic Trust has an 83% return, Fraser's Logistic and Commercial has 71%, Capital Land India has 44%. But what I wanted to show is that overall, the performance for overseas REITs have been very underwhelming. Maybe you will be arguing that, oh, but it's just 5 years. What if you look at 10 years? Okay, so the reason why I was looking at 5 years is because most of the overseas REITs were listed within the last 10 years. So most of them do not have that trading history for us to compare, right? But I still did a 10-year version, and that's how you can compare. Let me blow it up for you, right? So you can see that this is the 10-year total return, and yes, we still see the outperformance for the Singapore-based REIT, right? So over the past 10 years, the average Singapore-based REIT has returned 68%, while the overseas REITs have returned average of 34%, right? It is better, right? At least it's still positive, okay? But you can still see that the outperformance for the Singapore-based REIT is more than double the average performance of the overseas REIT, right? 68% for Singapore-based versus 34% for overseas REITs. So hopefully that will give you some idea of the comparison between Singapore-based REITs as well as overseas REITs. But now I want to share with you the reasons why I think the overseas REITs are facing more challenges as compared to a Singapore-based REIT. Okay, so the first rule of thumb in investing is that if you can avoid problems, avoid problems. Okay, don't be so gung-ho because problems do create headwinds and issues for companies, and that can account for the underperformances in their stock prices. So first of all, let's discuss why Singapore-based properties tend to do better, right? There can be many factors like this, right? First is strong Sing dollar, and a lot of the overseas properties would collect in foreign currencies, and if these REITs are listed in Singapore, when they convert
that currency back to Sing dollar, you might see some forex losses. So Sing dollar has always been quite a strong currency, and that is not good news for any foreign currency to be converted to Sing dollar. Second is Singapore does have a resilient economy. We have a very big sharp recession during the COVID period, but it didn't kill Singapore, okay? And the economy go back pretty fast and things stabilized pretty fast as well. So that cannot be said for many other countries, right? Especially the more developing countries. They might still struggle a little to get the economic engine starting again, but Singapore is way past that. And third is that Singapore has been business friendly and there is a lot of continuity with the policies, right? So there isn't any big surprises that may come. A lot of things can be well anticipated in advance. So that would not shock any businesses that much. Number 4 is political stability. There's always been one party in charge, so there isn't much changes to the political direction. And 5 is that it has no natural disasters, right? So generally properties are pretty much safer in Singapore compared to other countries. So the next thing is that I want to share with you more examples why the Singapore-based REITs are indeed performing better. So the very first impact we want to address is the forex, right? So one of the example that I use is this Cromwell REIT, which has a lot of properties in Europe. It has a euro counter and it has a Sing dollar counter, okay? So I want to show you the impact of this. Based on their last financial year, you can see that if they price the NAV in Sing dollar, converting from euro to Sing, they will see a 7.2% drop in their book value. That is quite a substantial drop. And we're talking about millions of dollars, right? Just because of forex losses. So this forex impact is not to be belittled. The next one that I want to discuss is more to show you that economic resilience of Singapore. So a very good example where we can compare is in the healthcare sector. There are only two healthcare REITs. One is a Parkway Life REIT and the other one is First REIT. So Parkway Life REIT has a lot of properties in Singapore, right? Mount E, Glen Eagles, Parkway East. All these are your top-notch private hospital in Singapore. As compared to First REIT, it has majority of the hospitals in Indonesia. And let's take a look at Parkway Life REIT first, right? This is their distribution per unit. And their distribution per unit has been growing since they IPO. And you can see that even during COVID, which is in FY 2020 and even leading to FY 2021, they managed to increase their distribution per unit during the worst of times. So you can see that resiliency in this pool of properties that Parkway Life REIT possess, right? Mainly, most of the revenue comes from the Singapore hospital. And next, let's look at First REIT. Okay, so this is a First REIT distribution per unit. You can see a very sharp drop in 2020, right? That was where COVID happened. And subsequently, it haven't really recovered the DPU before the pre-COVID levels. And even in terms of share price, right? Comparing Parkway Life REIT, over the past 5 years, it got up 69%, while First REIT has slumped by 68%. For the same period. It's almost like a mirror image. One is up 69, the other one is down 68. So you can see that having the properties in Singapore and enjoying the more resilient economy can help a REIT perform better as compared to a foreign REIT. In this case, Indonesia economy, Indonesia spending may not have gone back to the pre-COVID levels. The next thing I want to address is the consistency in policy and being business friendly. We also have REITs that have properties in China, and we know what happened for a good part of last year. China has been in an extended lockdown, and there has also been many clampdown on economic activities, even in the property sector. So that will impact some of the property valuation, and in turn the REITs will get impacted as well. So this is a busy chart. You can see that there are quite a number of China REITs listed in Singapore. So we have Sassia REIT, we have Capital Land, China Trust, we have BHG Retail REIT, and we have Daxing Retail REIT. And I throw in a Fraser Centrepoint, that is the Singapore-based REIT. Okay, which is a retail REIT. So all these are retail REITs, all these are shopping malls, and it is more apple-to-apple comparison. So yes, we have outlier. You can see that Sassia REIT is up 36% over the past 5 years, even beating Fraser Centrepoint. Singapore Heartland Mall REIT was only up 28%. So you do have outliers like this, right? So it's not all foreign REITs don't do well. Okay, you have Sassia REIT as outlier, but you can see that Capital Land, China Trust, BHG Retail REIT, and Daxing Retail REIT has all lost money in the past 5 years, even after including dividend gains. So investing in a country where there is more policy consistency does give better performances. You might think that, oh, it is a developing country, right? We are compared to Indonesia, we have compared to China. They are both considered developing countries, while Singapore is a developed country, right? But next example, I want to bring in the US. Okay, so this is the US office occupancy rate, and you can see that after COVID happened, the US occupancy has dropped and the vacancy has gone up, right? Because they are inversely related. So the vacancy in 2022 was 12%. Okay, so the flip side is that about 88% are occupied, 12% are empty. And this is due to the work from home culture that has not really changed or diminished after COVID happened, right? So people don't want to go back to office, okay? And let's compare that to Singapore. So Singapore occupancy has also dropped after COVID happened. There's also an incident of work from home, but the vacancy is not as bad. It's just 5%. So which means on average, still a 95% occupancy rate, which is still rather healthy. And that is why the Singapore office REITs are less impacted as compared to the US REITs. And this is to show you the impact of the US-based office REITs. So we can see core REIT is down 33% for the past 5 years. Prime REIT was down 59%, and Manulife US REIT is down 71%. And you can see the acceleration started at the start of last year, 2022, caused by the rate hikes, right, that caused REITs to be less attractive and also impact the US market demand for office, but largely is due to the work from home demand, and occupancy for these offices did not really go up. And then yet they have to serve a higher interest payment for these US properties. Of course, geography is not the only reason why REITs underperform or outperform, right? I also have shown you that there are outliers like Cecil REIT, which is an overseas REIT, could still beat a Singapore-based retail REIT. There could be other reasons that cause the difference in performance, right? Some can be because of the location of property, some can be because of a stronger sponsor and better management that can yield better results from the properties in the portfolio. So there can be definitely other reasons that we can look at, but I just wanted to still give you a statistics that generally overseas REIT don't do as well, right, on an average basis. And there are valid reasons why they have more challenges to deal with as compared to a Singapore-based REIT.
Hope you have enjoyed the video. Remember, download the REITs 2023 handbook. The link is provided in the description below.